The stock market is having a tough September. The S&P 500 is down about 5%, the Dow Jones is down about 3%, and the Nasdaq is down about 7% in September. Now, there are a few factors coming together putting downward pressure on the stock market. Number one is higher oil prices. Number two is what's going on in the treasury market. And number three is, let's call it the central forces, the government and the Federal Reserve Bank. Now, the Federal Reserve Bank has been a big positive influence on the stock market in 2020 and 2021 and a little bit into 2022. But now with the higher interest rates, they've been putting a little bit of a cool down in the economy. About a week ago when the Federal Reserve Bank met, what they said is we're not going to increase interest rates in September. However, you should potentially expect another interest rate hike in 2023. And that has some people potentially concerned because not only did they say that, but they also said that you should expect interest rates to stay higher for longer. The Federal Reserve Bank essentially said that you should expect interest rates to stay high through or into 2026. Now, the reason why that matters is because higher interest rates can slow down the housing market, selling car loans, general shopping because credit card debt is higher, and it makes business debt more expensive as well. So while a lot of people were hoping the interest rates would start to get cut in 2023, it doesn't look like they might get cut for longer than expected. Now, here we are today, and there are potential concerns about the economy, which I've highlighted multiple times. And then on top of that, we are seeing oil prices rise. Oil prices just hit over $90 a barrel. And the reason why that's happening is because, well, OPEC plus the countries like Saudi Arabia and Russia have been cutting the production of oil to cause oil prices to rise. Now, of course, here in the United States, we're still reliant on outside oil. And so now we are seeing the prices of oil rise, which impacts not just gas prices, but the prices of everything. And the reason why that matters today is because the last few months, we have been seeing inflation slowly start to tickle upwards. Now, why are we seeing inflation start to go up? Well, one of the reasons is higher gas prices. In fact, in the latest inflation report, the White House put out a statement saying that the reason why we're seeing this temporary high inflation is because of higher gas prices. Well, if inflation is being caused by gas prices and gas prices are going to continue to go up because of higher oil prices, what does that mean for inflation? Well, I let you guess that. But now this is where you have to also remember that the Federal Reserve Bank is working to raise interest rates in order to fight inflation. So now you can see where the problem is here, because the Federal Reserve Bank is working to fight inflation. If high gas prices are contributing to higher inflation, higher oil prices lead to higher gas. That leads to this big circular problem of, well, does that mean inflation is going to continue to get worse? If inflation continues to get worse, that means higher potential interest rates. Higher interest rates mean more pain for the stock market. So that's kind of the dilemma that investors or traders are seeing in the stock market, which has put some downward pressure on the stock market. This brings us to the topic of treasuries. And this is something that we've been covering in Market Briefs. If you have not joined Market Briefs yet, Market Briefs is my free financial newsletter where every day my team is working to break down what's happening in things like the economy, interest rates, the stock market, the housing market, the global economy, and crypto into a fun, witty, and easy to read email. You can read it in less than 5 minutes every morning, and it's completely free. So if you haven't joined Market Briefs yet, I got the link for you down in the description below. But the thing that you want to remember regarding treasuries is treasuries are an alternative place for investors to put their money. Now, what is a treasury? Treasuries are a loan that you can make to the government. These are considered risk-free investments. So if you are an investor, let's just say you're sitting on $1,000 or $100,000 or $10 million, it doesn't really matter. You have a decision to make. Where are you going to put your money? Are you going to put it into a savings account? Are you going to put it into a high interest savings account? Are you going to put it into a treasury, or are you going to put it into the stock market? And what we've been seeing happen is that treasury yields have been rising. Now, part of the reason why they've been rising is because the Federal Reserve Bank has been working to increase interest rates. Another reason why they've been rising is because the Federal Reserve Bank has been doing quantitative tightening, meaning they've been selling off some of their treasuries, causing yields to rise. And another reason why they're rising is because investors are just naturally worried about a potential recession. So now you have treasury yields rising. The 10-year treasury just yesterday passed over 4.6%. We haven't seen this number in about 15 years. And the 2-year treasury is above 5%. Again, we haven't seen numbers like this since 2006, 2007. So now, if you are an investor and you're sitting on some sort of cash and you're looking for a place to put it, you're deciding, where should I put this money? A high interest savings account, the stock market, or a treasury? Remember, treasuries are known as risk-free investments. And so now if you can get a guaranteed 4.6% return over the next number of years, that might be a more attractive investment for you than maybe the stock market. Now, I'm not advocating treasuries. I'm just telling you the mindset or questions that an investor would ask. And so naturally, what we have been seeing happen is some investors, some institutions are saying, you know what? This is a good enough return. These treasuries are good enough returns. And so some people are instead of putting money into the stock market, they're putting some money into treasuries. Now, why does that matter? Because if you have less money flowing into the stock market, you have less buyers in the stock market. If you have less buyers in the stock market, less pressure to put or push stock prices higher, because stock prices are ultimately a byproduct of supply and demand. When you have more buyers than sellers for a stock, the stock is going to go up. When you have more sellers than buyers for a stock, well, that stock is going to go down. So as treasury yields rise, it creates more of a question for investors as to where should I invest my money? Should I put it into a treasury or should I put it into the stock market? And a couple of years ago, that was really never a question, because the yields you would get on treasuries were next to nothing. So there was really no debate of should I put my money into bonds or should I put my money into stocks? It was I should put my money into equities, stocks, or some sort of other investment class instead of bonds, because bonds were yielding next to nothing. Now you're starting to see some decent yields in treasuries, and you're starting to see a little bit of money move there, which means a little bit less money going into stocks. And then we have what's going on with the United States government and, of course, the Federal Reserve Bank. Now, I'm not going to go too deep into this potential government shutdown in this video, because that's going to make this video a little bit too long. But not surprisingly, again, there are issues of a potential government shutdown. Now, what does that mean? Essentially, what that means is, well, some government things will not be getting funded. Now, chances are, like every other time, there's going to come to some sort of conclusion, and the debt ceiling is going to be raised and the government's going to print more money. That is what has happened before. But the reason why this matters is because the United States government has already been downgraded once this year by Fitch. Now, you've had other rating agencies like Moody's come out just recently saying if the United States government shutdown happens, that's going to be bad for the government's credit rating. Now, why does that matter? Because the United States debt is held by a lot of people. And we're talking about regular people, institutions in the United States, and foreign governments. So now, if the United States government and our debt is being downgraded, now people, institutions, countries are looking at the United States government saying, we need better returns to justify a risk. Because the riskier an investment is, the better returns you need to justify making an investment. Why does that matter? Well, that goes back to treasury yields. As treasury yields go up, now it makes it a little bit more of a justifiable investment, because now you're justifying that risk. But there's a cost. Everything has a cost. Higher treasury yields have a cost too. What is the cost of a higher treasury yield? Well, that means the government has to pay out more money in interest. The fastest growing expense for the United States government today is not the military, it's not Medicare, it's interest expenses. And the reason why their interest expense is rising so quickly is because, number one, their debt balance, their overall national debt, is growing so quickly. And then number two, the interest rate on this debt is also rising very quickly. So it's a double whammy. You're seeing the government debt go much larger, and now you're seeing the cost of servicing that debt also increase very quickly. So when you have higher treasury yields, while it can benefit you if you own some of these yields because you get higher returns, it also means the government has to spend more and more of its money paying back that money plus interest. And that comes at a time where if you see more of an economic slowdown, that also means less tax revenue for the government. Because anytime you see a recession, that means businesses make less money, that makes individuals make less money, and people lose jobs. The less money people make, the less money that goes in taxes to the government, and the less profits that businesses make, well, that means less money that goes to the government in taxes. So you can start to see why that's an issue. And then, of course, we have the Federal Reserve Bank, which I kind of hinted at a little bit earlier in this video. But the Federal Reserve Bank is kind of uncertain, or at least that's what they're saying on what they want to do with interest rates. Because on one hand, they keep saying that they want to bring inflation down. Inflation has been rising. Inflation is still hot. They're having a tougher time than expected to bring inflation down. But at the same time, they also understand the implications of higher interest rates. And the implications of higher interest rates are a slowing economy, potential recession, and higher unemployment. So they're trying to play this teeter-totter, trying to figure out what do we do when it comes to interest rates. And in their most recent meeting, they kind of left everyone hanging that expect interest rates to stay higher for longer. And you should also expect interest rates to potentially go higher from here. So what does all this mean for you? Now, I've highlighted this many times, but this is why it is important for you to get financially educated. This is why it's important for you to be financially prepared. Now, I've said before, 2023 is not the year for you to go out and finance a new truck. Although, if you want to look at Raptors, you can look at them, but don't go out and buy one this year. This is the year for you to go out and get financially smart, build that financial cushion, and work to also build that financial education. That way you can go out and build the opportunity to take advantage of opportunities, create that opportunity to take advantage of opportunities. And in order to do that, you have to be financially educated and you have to be prepared, because there's a lot of different things happening, not to mention the fact that we're just a few days away from student loan payments actually starting. Not student loan interest, but student loan payments. So if you have student loans, I highly recommend you go and take a look at those ASAP, because your interest is accruing right now and you don't want to overpay on your interest.